Okay, here we are, Module 6. Now, this is on trade management, and I know that I shouldn't play favorites, but I must say that this is the most important module of this course. Understanding the techniques for how to manage risk is crucial. It's critical to your long-term success in trading futures. So what does that entail? What will we look at? Well, we're going to look at several things. One, techniques for protecting your capital. And then using stops. We're going to talk about techniques for placing stops. And then number of contracts and how that affects us. All right, let's get started. All right, so on protecting capital. Now, futures contracts require a high degree of risk management. Say that to yourself several times. It is absolutely critical. Now, there are risk management rules that you should establish, and each person needs to establish this, right? This is critical, that you create a risk-averse strategy and style for trading futures. So, for example, this could include the conditions for when you will and will not trade. Now, this may translate into several things, right? It may mean that you won't trade at certain times of the day, or on certain days of the week, or even on certain times of the month. All right, so you need to understand when it is you will trade and not trade. Another is you need to understand and declare what percentage of your portfolio will you risk per trade. All right, absolutely crucial. And then the third one that I'll mention here is level of loss, right? You need to determine what's the level of loss or the risk that you're willing to accept per trade. Now, what this means is, let's say that, you choose to decide not to lose more than 4 ticks of price movement that goes out, that goes against you in some sort of trade, before you actually get out. All right. So those are critical, right? So establish risk management rules up front. And so the key takeaway here is this is the most critical topic. Managing your risk is job number one. It's obviously very important to understand your trading style, because that actually influences then what's the risk management level that you're actually willing to adopt. Okay? So let's look at some examples on this. All right? If we're going to protect our capital, let's say we had a $10,000 account and we declare, look, I'm not going to tolerate more than 1% loss per day, which in this case would be $100 a day. What does that mean for different futures contracts? So it means not only do you need to understand yourself, but you also need to know how is risk translated into the price movement on different futures contracts. So here I am on the E-mini S&P, the ES contract. If I was to lose $100 on a day, it means that it would have moved 8 ticks or 2 points. It's the same thing. 2 points against me. At that point, I'd say, oh, done for the day, right? Okay, here's the next one, another example. The NQ, which is the NASDAQ. Again, $100 on that contract is different. It means that it would be 20 ticks of movement, which would translate into 5 points, all right? Let's look at oil, QM. Similarly, 8 ticks, which translate into $1. It gets measured a little differently, but that would then translate into $100 that would be lost. Gold, so 10 ticks, which would translate into $1, would then be $100. And of course, corn, 8 ticks, which is 2 cents, would then translate into $100. So establish your boundaries for loss management, not only in terms of knowing your personality and what risk level you're comfortable with, but also you have to map that then into the futures contract that you're trading and what level of price movement then you can tolerate or not. All right, so let's talk about stops. All right, we have to have stops. Now, buy stops are used when you are in a short position, right? Meaning you opened a position with a sell. You went short. What that means is when the market reverses and turns against you and begins to rise back up, it will hit your buy stop and close you out of your position. Hence, it's a stop management tool, right? In fact, sometimes you avoid saying stop loss because you can't always guarantee that it will get you out exactly at that location, right? There can be some level of slippage. but it is your stop management location where you set that stop. All right. The next thing here is a sell stop. So this is just going the opposite direction. So sell stops are used when you're in a long position, meaning you opened a position with a buy, right? You're going long. But in this case, the market reverses, turns against you, and starts to sell off. And it's going to hit your sell stop and close you out of your position. All right. So it's critical to know that when you use buy stops, right, you open a short position. And when you use sell stops, you open a long position. The location of these stops, where you put them, should be based on the risk management rules that we talked about earlier. So you really have to practice, right, to find out what's the right level of risk that you can tolerate or not. Now, there are some techniques for placing stops. So not all stop locations are created equal, right? And so you have to figure out where that goes. Each of us has to decide. You have to decide which technique fits your personality and your trading style. So I'm going to introduce these here, right? It's so critical. I can't emphasize this enough. It's very crucial to test your stop management using virtual or paper trading for a while, because you got to find your trading style and the approach that fits you best, right? So do that for a while using these different techniques to figure out what's going to work best for you. So here's some examples, right? There's a style of placing stops based on ATR, average true range, or another one based on moving averages. Another one using mean reversion or channel boundaries, or using support and resistance lines, or using trend lines. So each of those are potential techniques for placing stops. So let's look a little bit closer at these. So ATR, as you most likely know from your other technical analysis background, and if not, it's the average true range technique that's performed when you use the ATR indicator. We won't go into that, right, at the moment. But you put it on your chart. And what you do is it helps you to understand the current price volatility level, and it gives you guidance on how far away to set your stop. So it's totally based on how the recent or most recent activity, movement of price has gone. Then that will give you guidance based on that as to where you put your stop. That's ATR. Moving average, as you would expect then, says for some period of time we're going to base this moving average. It might be for a 21 period moving average of time. In any event, you pick your moving average time and then you put your stop below that moving average or above it. That's another technique. And here's another one, right, which it has to do with the reversion or the channel. There's several techniques that are used to model or to draw channels, reversions. And one of those is called a Bollinger Band, or another is a Keltner Band. If you don't know what those are, certainly go look those up. But some use those as ways to put your stops out over the edge of, let's say, the edge of the Bollinger Band or of the Keltner Band. There's certainly support and resistance. This is, of course, fairly common, right? As you hear people talk about trading, they'll often use this technique a lot. They'll find common support and resistance lines, and then they'll put stops on the other side of those. And then the last one I mentioned is, of course, trend line. This is also fairly common, especially when you get into a trend. And you'll start following up the trend, and people will put stops below those or above the trend line. All right, what's important, the key takeaway, is to understand the different kinds of these stop management strategies, and then to figure out, for the way you want to trade, for how often you want to be involved, what's going to be the best strategy to use that fits your risk profile, and then know how to map that into the actual futures contract that you're trading, right? What does that translate into then? How many ticks away or how many points away then do you put your stops? So the last piece that I'll mention here has to do with number of contracts. Now, this is an area where most traders run into problems early on, most futures traders, right? And it starts this way. You start doing your technical analysis, you're on your charts, you've picked out your risk and your stop management strategies. But what happens is you get lulled into the blinking lights, right? Oh gosh, you start doing the math on profit potential. Hey, if I could make this much money with one contract, What if I did 2? What if I did 10, for crying out loud, right? And so this happens quite often, that new traders in the futures get started with too many contracts too soon, and it risks their capital. So be sure to practice with a virtual or paper account for some time and figure out what you're able to tolerate. After you get more training, start with one contract and get a coach to help guide you through the learning curve. So it's important to start with a small number of contracts. That's the key takeaway here. But only after taking more training are you prepared to do futures trading. So this course does not prepare you to enter futures trading live. Don't go do that. You need to get a lot more training before you go do that. Okay, so what did we learn in this module? Well, first of all, we talked about protecting your capital and how important that is. We also then spent time looking at stops, and we introduced different techniques for stops. We talked about what kinds of stops there are and how to, different techniques for applying them, with the emphasis on practicing what is the right stop management strategy for you. And then finally, we talked about the numbers of contracts and how it is that we should manage that and keep that small. Well, that's it for our Futures 101 course. So excited that you took the time to go through this. Always feel free to reach out to the tackle trading coaches for additional questions in this area. Thank you so much for joining.